Hello and welcome to Moneylife News and Views. I am Debashis Basu. In the last few weeks, India's two main financial regulators, that is the Reserve Bank of India and the Securities Exchange Board of India, have flexed their muscles to teach some financial market participants some basics of prudence as well as regulatory compliance. First, the RBI imposed business restrictions on Payments Bank for repeated violations of norms over several years despite warnings. And then the central bank barred it from accepting deposits and credit transactions after March 15th, which could effectively mean curtains down for the bank. It's a payments bank, but still a bank. And then on March 4th, RBI imposed an embargo on IIFL Finance's gold loan business, and on the next day, it banned loans against shares and IPO financing of JM Financial Products, citing persistent regulatory non-compliance and governance issues. And then, at last, in March 7th, which is one of the last of the series of regulatory actions by these two, on March 7th, the SEBI, the Securities Exchange Board of India, prohibited JM Financial from taking any new mandates to serve as a lead manager for the public issue of debt instruments for flouting regulatory norms. Now, separately, alarmed by the money flooding into small cap and mid cap mutual funds, which could make the market frothier, SEBI has asked mutual funds to take risk containment measures. They wanted them to moderate the flows and rebalance portfolios and disclose risks or the results of a stress test to investors, which is almost every month. And the test, that is the stress test, would cover liquidity, would cover volatility, valuation of portfolios of such schemes, etc., along with guidance, in SEBI's words, along with guidance in a simple language, assumptions and methodology to enable the investors to understand the associated risk. Now, AMCs, that is the asset management companies of the mutual funds, would be required to state the number of days required to liquidate 25% or 50% of small cap and mid cap portfolios. This is important because many of these scripts are going to become illiquid. They're very liquid now, probably because of all the frothy trading that is going on. But once the market starts falling, suddenly liquidity will disappear. So it's very important to know that in that situation, not in today's situation, in a situation when there is a market-wide decline, how will these small caps hold up? How many days will it take to liquidate 25% or 50% of the portfolio? Of course, this is purely academic because no mutual fund sells 25% of its portfolio. They just keep holding those shares. Mutual funds never go beyond 10% or at the most 12 or 15% of their money in cash. In fact, that's an outlier. Most of them have only 3 to 5% in cash. But anyway, SEBI wanted them to do all this stress test and also in a simple language, SEBI's words, communicate the implications of financial jargon such as annualized standard deviation and portfolio beta, etc. I don't know how many people will understand this, how many people will pay attention to this, but these efforts are required not for the benefit of the investors. They're not going to read, they're not going to understand. But these are a message to fund managers to be careful. If they don't, then SEBI can anytime come back and say, I did tell you to do this, but you haven't. From that perspective, it's important. So RBI's and these actions, these kind of regulatory actions, nobody likes, and nobody likes, especially in a booming economy, in a booming stock market. Regulators are seen to be, spoiled sports coming when we're having so much of fun buying stock today, which goes up 20-30% in a few weeks. I mean, who are these regulators to come and tell us what to do, right? So Paytm, in fact, for instance, is a poster boy of fintechs, and a group of fintech investors and entrepreneurs actually went up and petitioned and actually appealed to Nirmala Sitharaman and the RBI governor to review and reconsider the regulator's decision, even though this decision has come after years of warning and non-compliance. Even then, they want, as they say, give me one more second chance. The action against IIFL and JM Financial brought out protests from these companies. JM even argued it's quite remarkable that there have been no material deficiency in our loan sanctioning process. We have not violated the applicable regulations, no governance issues whatsoever, and we conduct all our business and operational affairs in a bona fide manner. This is what JM has officially claimed. Now, of course, that was until SEBI's order came on JM. This was what they said about RBI's order. Now, SEBI actually has a reasoned order, unlike RBI, which just issues a press release or a public announcement saying that this is what the decision is. SEBI actually puts out a reasoned order when they take any action. So there's a show cause notice, there is inspection, there is investigation, they call for information, and then finally the order is issued. And that SEBI's order exposed very clearly absolutely questionable practices, such as, to quote SEBI's report, getting individual investors who would otherwise not have participated in the issue, on a public issue, to make applications not just by providing funds to them. The JM provides the funds, goads them to invest, and then also by assuring them an exit at a profit on the listing day. This is not the job of a financial intermediary to goad you to please invest. I'm giving you the funds. I will ensure that you exit at a profit on the listing day. This is clear violation. This is manipulation. Regulators, as I said, are the bad boys. Nobody really likes them. Okay, so they spoil sports. They are in an unenviable position. If they act ahead of a potential disaster, they are criticized. And far from getting kudos, they are criticized because what they do is at odds with some people's or most people's financial interests. I mean, there are lots of vested interests, there are normal interests, and people don't like brakes to be put on them. Okay, but if they don't act, they are blamed for being lax when the actual disaster hits. I'll give an example. We know that the 2008 global financial crisis was caused by absolutely rampant speculation in real estate, mainly in the US, but also in Europe, in many parts of Europe. Iceland as a country actually went bankrupt because of this kind of speculation. Now, the US Federal Reserve and a couple of other regulators who were supposed to keep an eye on this were found to be sleeping when all this was happening, and there was enough of evidence. There were whistleblowers, there were articles written, people bet against them and made money. All of that happened, but regulators had openly said that there's nothing to worry. In fact, Ben Bernanke, who was the US Federal Reserve, had said that there is just nothing, no problem at all in the US real estate market and the subprime mortgages market. And he kept on saying this right up till the crash actually started happening. Now, do you remember any such thing, a subprime mortgage crash or any such thing in India? You don't, because in India there was no frenzied speculation in real estate and there were no excesses. It was not allowed to happen. And this was because the RBI under the Gopal Reddy kept increasing risk weightages on bank lending to real estate to curb such an irrational lending. I mean, he noticed what was happening in the US and he made sure that doesn't get repeated here. Now, this caused a lot of irritation at that time. I remember we meeting the head of one of the best private banks, and he said, he was extremely upset and he was complaining that RBI is being silly, they're being overcautious, and so on and so forth. But thanks to that prudent approach of the RBI, consumer spending remained unaffected. The Indian economy kept growing. The stock market did crash because of forced panic liquidation by foreign investors. All right. Now, at that time, SEBI was actually found wanting. Today, they are much more proactive. If SEBI had been as proactive as the RBI, Indian mutual funds could have been prevented from foolish investments in fixed maturity plans, which was the cause behind Lotus Mutual Fund going bust and having to be rescued through a merger. There are enough good reasons today, frankly, why RBI and SEBI's current actions are correctly timed. What they're doing is right. The Indian stock market has been on a tear over the last year. Froth in small cap stocks is absolutely obvious. And this is now very clear in the last 2 days of fall, right? In the calendar year 2023, the NSE microcap index was up 66.1% in 1 year, while Nifty was up only 20%. These returns are far above long-term average. Now, if in a 1 year your return is very higher than long-term average, it's simple arithmetic that in future the returns have to be lower for that average to actually come down, because it can't be 66% again next year, or even 40% or even 30%. The long-term return is about 20-25%. Somewhere the returns have to really go down or be negative for that 66 to come down to an average of 20-25. But who's willing to accept any such thing? Instead, egged on by market intermediaries, investors are plowing money into small cap funds, flipping IPOs on the listing day, apart from, of course, trading massively in options, which is now, talk of the entire financial world, not only in India, but internationally. I mean, Indian options are now like 75% of the total global derivatives and stocks. I'll end with a very interesting quote by William McChesney Martin, who was called the Wonder Boy of Wall Street, because at 31 he became the chairman of the New York Stock Exchange. He had a fantastic public life in the financial market, and he was longest serving Fed chairman between 1951 and 1970. He had famously said that the task of the Fed, that is the Federal Reserve, is to take away the punch bowl, the drinks, just as the party gets going. Now, the party has been in full swing in India. It is clear from the widespread non-compliance and funny schemes of these companies, JM and IFL and so on, and various other market participants you will get to hear soon. In such extreme situations, the objectives of regulators will not necessarily match with that of the market participants. They will be at variance, at odds. So what best illustrates this than the comment of Chuck Prince, a former Citibank chief, who, in contrast to what Martin had said in the 60s, he had famously said in 2007, Chuck Prince's comment in 2007, 6 months before the market crash, was as follows: as long as the music is playing, you need to get up and dance. Now that is an honest admission of how the financial game is played, how people in the financial markets think. But then finance is too serious a business to be left to party swingers dancing and drinking till people get hurt and the regulators have to come up and clean up their mess. If you liked what you heard, please do subscribe and please do share. Thanks for watching.